Art planning. Why did they have
Well, thank you, Elizabeth, and good afternoon. I really appreciate the opportunity to stand before you today. I have the team here with me, and so I wanted to ask them just to tell them what your area of responsibility was for the county. So, Melissa, if you don't mind sharing.
at least met with you before? On-site people?
And Mark. Thank you, Mark. And my area of responsibility really is to oversee the team. I'm also the main contact for Columbia County, so if there's ever any issues, I just want you to call Melissa, and she'll. All kidding aside, we really appreciate the relationship. As Elizabeth has mentioned, it's been a really nice 12-year run. I also want to just take a moment to thank the HR staff, Marsha Lowry, Elizabeth McBurney, Kristen Price is here. I think you guys know this, but you have one of the best HR staffs. And so thank you all very much. And they're not just clapping because you all paid for lunch too, I don't think. Well, we want to talk to you today about investing in volatile markets. And unless you've been ignoring the news, which is probably not a bad idea considering all the agendas that are being pushed out there nowadays, you will, or have lived under a rock, you will have noticed the stock market has been very volatile. You'll see 700 points up, 200 points down, 500 points up the next day, 300 points down the day after that. In fact, Conan O'Brien said it the best when he said on a late night TV show, he said the stock market dropped 600 points yesterday, and then the next day it was back up and down 6 other times. It's kind of like me after 3 apple martinis. So he described the stock market to a T, which is it has been very, very volatile. And that volatility is scary. No matter who you are, when you see your market drop, when you see your account drop significantly, there's some emotions that are tied to that. We've been in the business, I've been in the business 25 years, I am not immune to that either. So our goal really today is to help you understand that volatility, how to use it to your advantage. We want to encourage you to stay the course, so we're going to give you some ideas on how to do that. Mark's going to come up and share some best practices, and then Melissa's going to bring home the presentation for us. So let's first talk about why we invest. Why do we put ourselves through this? I mean, why do we put ourselves through all these ups and downs? Because it is our money, it is our retirement savings, and I think you all know we're sort of emotionally tied to that. That is what we plan on living on. That is our nest egg. So why do we do it? Well, what we want to do is to put our savings to work for us. And I've heard it said best, and this is out of a book called The Millionaire Next Door, and it basically says that you want your money to work for you while you're working for your money. And that's a really nice mentality to have because it says you understand that money can work for you over your 35 to 40-year working career. So why do we invest? Because we want that money to grow. Also, a basis of understanding I want all us to agree to, and I'm going to show you some slides in a minute, is that there is no such thing as avoiding risk. Now, you can say I'm going to avoid stock market risk, but then if you avoid stock market risk, you're taking on other types of risk, like lost opportunity, like what they call inflation risk. What does that mean? Well, let's say you take money out of the stock market and you put it into a fixed account earning about 2% a year, but yet the cost of living is going up by 2 to 3% every year. So if you're earning 2%, but that dollar is being eroded away at 2% or 3% every year, are you really building any wealth for retirement? So the whole thought is you can avoid stock market risk, but there is always a type of risk that you're going to take with your money, regardless of whether it's stock market, inflation, or other types of risk, which we're going to talk about. Also, avoiding risk can require more savings. We're going to show you that if you want your money to work for you over a 35 to 40-year working career, if you put money in the stock market, how it can grow faster. If you decide not to use stock market, then what we're going to see is that you're going to have to save more, and that's not always an option for everybody. So we want to talk a little bit about that as well. And lastly, stock market does come with risk, and we're going to talk about that. So I want to show you, moving into the presentation now, I want to show you historical risk versus reward. So you'll see stocks, you'll see bonds, and you'll see cash. This is a chart from 1926 to 2015, and these are average annual rates of return. So stocks have returned over that 90-year period about 10% per year each year. Bonds about 5.1%, and your short-term instruments like cash, money market, CD about 3.4%. But what do you notice about the worst one-year return in stocks? You can see it was a negative 68% around the Depression era. Bonds only dropped 13%, worst rate of return in 1 year. Cash, you'll see a zero there. It's really about 0.4, I think, is a number, but it was rounded down. The point being here that stocks do give you a better average annual rate of return over time, but it also comes with risk. It comes with volatility. And I think it's important also to note that we talked about the fact that cash and bonds are a good part of your overall portfolio. We're going to discuss that. But there are some risks associated with that. Again, if you move money out of the stock market into a fixed account, the risk that you're taking is you're only going to not really make any money on your money. So we want to talk about that as well. So what I want to share with you next is one of the things that are really important to me, and this is the message that I want to get. Listen to this message, and then you can go into a after lunch coma if you want to. But this is the thing that I really want to bring home. And if you've ever been to one of my new employee orientations, you will know that I always talk about this. So this is the most common mistake that people make when they see market volatility. So here's what happens: they invest in the market, and then the market stops to drop. And so what do you think they do? Yell it out. They sell. They sell, right? They panic. I think I heard panic over there. So they sell, and they say, well, I'm going to sit on the sidelines, and I'll wait till the market comes back up again, and then I'll get back in. So the market rallies, starts to come back up, and they get back in the market. And then guess what happens after a few years? The market goes down, and they do what? Sell. I'll wait and get on the sidelines again until the market comes back up, the market goes back up, and then they get back in. This is a lot like changing lanes in bumper-to-bumper traffic. Anybody ever do this? So you're in the right-hand lane, and the left lane starts to move. This lane's going to move faster. I'm going to get over there. So I get in the left-hand lane, and guess what happens? It stops. And then the car that was behind you moves ahead of you in the right-hand lane, right? So you get in the right-hand lane, and it's starting to move, and then what happens to that right-hand lane? It stops. So this is what this is the mistake that investors make, is they panic sell. They see the market go down. They think it's a permanent event. They get out. The market goes up and down very, very fast, and it is very, very difficult to time the market. So the message I want to leave with you for my portion of the presentation is, please don't panic. Don't change lanes. Touch your neighbor, remind them, say, don't change lanes anymore. Don't change lanes anymore. So here's the proof statement. I wanted to show you, and again, I think this is 1995 to 2014. The left-hand side is the stock market portion, rate of return. The right-hand side is the bond market. The blue is the average rate of return the average investor got in the market. The orange is what the market did. What do you see here? What you see is that the average stock investor over that same time frame got about half the market rate of return. If you look at bonds, it's even worse. Why is that? Because people are trying to time the market. They're trying to change lanes, and it is very, very difficult to do. I always like to joke they pay people from Harvard millions of dollars every year to try to beat the market. And if you look at the average is only about 1 in 4 do it. So it's very, very difficult given the information to try to time the market. It's very, very hard to do. So again, we don't want you as investors to be changing lanes. We want to help you get into a proper allocation and then stay the course, because that's always the best opportunity for you to get a good rate of return. One of the other things I want you to think about avoiding is avoiding risk altogether, because we talked about the fact that there really is no way to avoid risk. If you avoid stock market risk, you're taking on other risks. But this is something called the rule of 72. And in finance, basically what it means is whatever rate of return that you earn, if you divide that by 72, that's the number of years it takes for your money to double. Now, I know we've all been out of math a long time, so I'm going to do it for you. I won't ask you to do it on the spot. But if you're welcome. But if you earn a 9% rate of return on your investments and you divide 9 into 72, that means your money is going to double in 8 years. If you earn a 4% rate of return, that means your money is, and you divide it into 72, that means your money is going to double every 18 years. And I've heard some of you already before then, and I see the wheels turning. You say, if I can get 24% rate of return over the next 3 years, I can double my money and retire. Please don't count on that, but that is the correct way to use the rule of 72. But here's the point. If you avoid stock market risk altogether and simply put your money in a fixed account, you can see the top chart, you earn 2%. That means your money will double, but it will take about 36 years to do that. On the same time, if you earn a 6% rate of return in the stock market, your money will double every 12 years. And so it doubles 3 times as fast. So I think the point here that I want to leave you with is that if you work a 36 to or 35 to 40-year career, how many times do you want, based upon the averages of the market, I'm not making this up, based upon the averages, how many times do you want your retirement plan money to double? I want you to think about that. Some of you in this room may have all your money in a fixed account, and if you do, that may be okay for you, but we'd like you to come sit down with us and let's talk about your asset allocation. The reason people go into the fixed account is because they don't want to take risk, but they don't understand that there are other types of risks they are accepting, and so we just want to talk about that. Now, before anybody, I know this is being recorded, so I want to just have this caveat. I am not here today to tell you that you should have all of your money in the stock market. That's not what I'm saying. What I'm trying to do is give you some facts and figures to show that having some exposure to the stock market can help you over time, and having the right asset allocation of stocks, bonds, and cash can give you a better rate of return to help get you to where you want to be. This is not the World Series of Poker, what you see on ESPN, where the guy puts his chips all in, right? And then he stands up and his hands are on his head. He's got a worry on his face because he is not sure what the next card is going to be, and he or she could lose all their money or they could win a big pot. That's not the investment strategy we're talking about today. We're just talking about having exposure to all of the asset classes, because getting a 2% rate of return is fine, but you're going to have to save more, which I'm going to show you in a minute, and your money's not going to be working for you as hard as it could be working. So speaking of that, I want to show you this other slide on the folks that want to avoid risk, some things they need to be thinking about. So you'll see here on the slide, if you earn a 2% rate of return, to get the same amount of benefit, the same end result, account balance end result as someone who's saving or earning 6% a year, assuming someone earns $50,000, you're going to have to save 22% of your salary, or $423 a paycheck. That same person who has a more diversified portfolio getting 6% rate of return only has to save 10% of their salary, or about $192 a paycheck. So you can use the stock market and the bond market to your advantage to help you grow your rate of return over time. Again, for those that are closer to retirement, you want to have less money in stocks and bonds, and you want to have more money in the fixed account. And Mark's going to come up here in a minute and give you some practical strategies based upon the information that we've just shared to help you make some good decisions for you going forward. But at the end of the day, taking low risk may be okay, but if that's your case, just realize you're going to have to save more. Lastly, I want to share with you just about panic selling. Here's another good example of what happens to investors and why, on average, investors earn a lower rate of return than the stock market. This is a real-life example. Everybody remembers back in 2007, 2008, the too big to fail, government bailouts, the big stock market crash. If you had $100,000 in October of 2007, by February of 2009, that balance would have been $49,000. You would have lost half of your account. But by December of 2012, it would have been back up to $103,000. Now, from 07 to 12, that's only a $3,000 rate of return. Not great. But what most folks did, or not most, but some, they panic sold, wait for the market to come back, and then they didn't have the opportunity for that $49,000 to come back above their original $100,000 investment. So again, this is that whole idea of getting a proper asset allocation, having your money spread out appropriately based upon your time horizon, your risk tolerance, and the fact of for your retirement goals, and then staying the course. Because again, these folks are going to be changing lanes in this scenario because it was a significant drop, and they're not going to be able to recoup the money that they had hoped to recoup because they're sitting on the sidelines. So I want to leave you with a couple of quotes, and then I'm going to turn it over to Mark, who's going to come in and bring some of the best practices and good ideas that you can use with your portfolio. This is a quote from Mark Twain. He says, October, that's a peculiar dangerous month to speculate in stocks. And then he goes on to say, so is every other month of the year. My other favorite quote is by Peter Lynch. He was a very famous money manager back in the 80s and 90s. He managed the Fidelity Magellan Fund at the time, which was the largest mutual fund in the world. He wrote a book that everybody who was in finance wanted to read called Beat the Street. But what he said was, and this is true, far more money has been lost by investors trying to anticipate market drops, that's what a correction is, than has been lost in all the market drops combined. What he's saying, and he was one of the most successful investors to ever live, that it's very difficult to time the market. You're better off just staying the course. So in conclusion on my section of the presentation, I just want to extend a helping hand. We're here to help you. This is not a church sermon where you're sitting there going, oh my gosh, I've made that mistake, I've made that mistake, I made that mistake. I'm not here to convict you, okay? I'm here to let you know that these are some of the mistakes that people are making, that we have to accept the fact, and we are not immune, that we are emotional when it comes to our retirement dollars. And when we have to make good decisions, we have to remove that emotion, and that's what Mark's going to be talking about today. But the whole idea is that, and the thought I want to leave you with is, please stay the course. That is the best, appropriate, and most successful, based upon all the numbers I've seen, and hopefully the numbers I've given you today, is the most appropriate way to deal with market volatility, because the market has shown over time, and Warren Buffett, who's one of the most successful investors, everybody knows his name probably in this room, he says betting against the American economy is the worst bet you can make, and he's always been right. The market always tends to rebound. The market always tends to come back. So I hope this was helpful. I want to turn it over to Mark. He's going to come bring some best practices and tips, and then Melissa and I and Mark are going to stick around if you have any questions after the presentation. Love to talk to you one-on-one. So thanks for the time. I'm going to turn it over to Mark.
Art, that was great. He's always a hard act to follow. So the great thing about retirement planning is you get to envision the 65 or 70 or 75-year-old you, right? Or maybe the 95-year-old you. That's the tough part about it. So along the lines of what Art was saying, let me tell a little hypothetical story just to kind of reiterate, put it into perspective. So there's three people. There's Art, Mark, and Melissa. We all start at the same company. We all put the same amount into our retirement plan over a period of 30 years. Well, at the end of the day, Art has $1 million in his plan. Melissa has about $500,000. I only have $250,000. How'd that happen? So Art got 8% on his money. If you look back, his average annual return was about 8%. Melissa's was about 4%. But I didn't take Peter Lynch's advice or Art's advice, and I was trying to time the market. I was changing lanes and going in and out, and making, the wrong move when I should have been making the right move, all these different things. So my return was about 2%. So and those, you add up those percentages, that's how big a difference it can make and result in your retirement portfolio. So with that in mind, the one thing I wanted to mention on the quote from Mark Twain, point is we talk about the markets being speculative, but I want to differentiate something. There's a difference between investing in individual stocks and investing in the market. And I think here he's talking about individual stocks versus the market. You can lose quickly and you can lose a lot, individual stock. So we like to say for your serious money, which is your retirement money, think in terms of managing that in stock funds, diversified. Speculate in maybe some other form or some other fashion with individuals. So keep that serious money in the different funds that are in your retirement plan, and most likely it's going to all work out great. I call this my roller coaster chart. So some people say, the market's like a roller coaster, or it's like riding a bucking bronco. So, on the roller coaster, the only people that get killed are the people that jump out. You're riding a bucking bronco, the people that get hurt are the ones that let go. So when you look at this, it looks like, boy, this is kind of insane, the market fluctuations. But the thing you want to look at on this chart is you want to see all those blue lines that are above the zero mark every year. So all those blue lines from 1980 all the way up to 2018 correspond to winning years. And the winning years, it ends up being 76%. So I like those odds. If I was a poker player playing a hand and it had a 76% chance, I would take those odds. The other thing that's most interesting about the chart is the red lines below. So if you connected all those dots, it would look like a roller coaster. So when you think about it, here's the thing. Our system, our economy, it is so resilient. I mean, that stock market goes down, but my gosh, it doesn't stay down. This morning, we're very close to hitting all-time highs in the stock. It's kind of incredible the way it works out. But it would be great if we had a little button we could push, and every time that market went down, maybe double digits inter-year, if I pushed a button and added money to my retirement account, that would probably be a winning strategy. However, our emotions keep us from doing that. So you just got to, that adage about buying low is true. When you look at this chart, it kind of exemplifies that. So just remember this chart. Remember all those blue lines that are in positive territory, and do not give up hope. We are a very resilient economy. Okay, the rule of five. So the biggest thing we worry about is 2008 happening again. Everybody remember 2008? Not good. But what happened? 2008, 2009, 10, 11. Stock market was back up with it. Around 3 years, it was back up to where it was, and it's been off to the races ever since. So we've had around 9 different crashes. Crash is like a 20% decline intra-year. And if you invested at the height of that market, or it crashed, every single occasion it has come back and recovered within a 5-year time. So here again, don't give up. Hang on. Don't jump off the roller coaster. The system works. We just keep our fingers crossed it'll continue working going forward, right? So here, 60-day chart. So this is the chart. I read these numbers. I know they're true, but it's still astounding to me. So we go back and we look from 1992 to 2018. Okay, I was in the S&P 500, and I didn't change anything. Didn't change lanes. I stayed fully invested. I had a pretty darn good return. I might be on track to $1 million with a 9% return. But what if I missed? I changed lanes. I made some changes. I didn't get invested, didn't stick to my plan or whatever, and I missed some of those up days, the big up days. So what happens? The market come crashing down, and then it'll go just jet rocketing up. Look at the performance of it. You want to be in there when the thing jet rockets up. So I could go into a coma for 60 days come out of it. I missed 60 days of my life, but hey, let's say I recover and I'm fine. I missed the 60 best days in the stock market. It's total devastation to my stock market portfolio or to my investment retirement plan portfolio. So I missed the best 60 days over that time period. My return goes to a negative 1.38%. This chart's in the handout too, by the way. So my perspective, my long-term perspective. So I was talking to someone, and this lady she was about 30 years old, and she was scared to death on putting money, allocating money into the stock funds, the growth funds. And I showed her this. I said, look, things can be really crazy in any one year. Things could be really crazy for personal lives and the stock market or whatever, right? But when you look out over 20 years, you're 30 years old, you're not going to retire until, let's call it 60. You got 60 years. But did you know there's never been a 20-year rolling time period where someone has lost money in the stock market? Like, no, it's hard to believe, but it's true. So we took all these rolling time periods. Now we're going way back on this one. We're going way back into the 20s. So this is a long, long-term perspective. But that should give you a lot of assurance. That should give you a great deal of insurance that you can have a healthy allocation to stocks. Different stock funds that we offer come out in pretty darn good shape. Don't, especially you got 20 years, you got 30 years, hang in there with it. The target date, anybody in the target date funds? Target date fund? So the target date, so if I'm 50 and a target date is 15 years, those target date funds are like 70% invested in stock. They maintain a healthy weighting there because the managers know this, they know the history. So keep that long-term perspective. Well, we got a colorful chart for you here. So we're only going back to 2009. So from 2009 to now, for those of you that have had money in your retirement plan, you've been pretty happy with it, right? This chart, this quilt patch chart, as we call it, is put together to try to illustrate the importance of diversification. So in Art, that great job he did allocating his funds, accumulating all that money, he stuck with 4 or 5 growth funds, different growth funds, over the course of that time. And so S&P 500, which would be represented by, we'll call that more large growth, small growth, developed, which is international, small value, large value, a balance. They throw a balanced fund in here in the gray, which is 60% stock, 40% bond, then bonds and cash. So these are the different types of stock funds, different asset allocation funds that you can use, bond and cash, to build your portfolio. And you want to have representation in at least several of these. That's the big point here. Because when you look across the top row, did the top performer ever repeat twice? The top performing fund never repeated twice. So you want to be spread out. You want to have representation in different. So you can get the job done with 4 or 5 different stock funds. Maybe you have some in the cash and some in the bond. So for practicality. So what happens is the individual that goes back every year, they look back at a prior year and say, well, that was the top performing. That's where I'm going to put my money. I'm going to go all in for that fund. How do you think it works out? It doesn't work out. It's not a disaster, but the fact is numbers bear out that they end up getting about half the return that they would have got had they been spread out and diversified. So, hey, diversification doesn't cost any money. They say it's the world's only free lunch. It doesn't cost anything. It's easy to diversify and spread your money out into different types of funds. Any questions on our quilt patch chart here? Control. So there comes a point in time in everybody's life where we have to take a step back, say, there's just things I can't control. I can't control my grown-up kids' lifestyle. Right? I can't control my wife's shopping. I can't control the markets and the economy. So I'm not going to worry about it anymore. And I focus on things that I can control. So in the context of what we're talking about here today, we can establish a plan. We can set up a plan. We can follow. We can think about the future 75-year-old you, about all the good things you want to have happen in retirement, how you're going to get there, and you create a plan to do it. That's what we do. We help people create financial plans. I can control them. I can control my spending, how much I save. If I get a part-time job or all these, there's options. There's things that I can do, and there's things that I control. Diversification, obviously, that's something you can control, or we can help you with that. And then probably the most difficult thing is managing risk and managing emotions. Go back, you have a plan, you have an anchor, have people that you can talk to, like Melissa, on an ongoing basis. That's going to keep your emotions in check. So you all came to this presentation today, so now you know and understand a lot more than most people do about how these markets work. You're already a step ahead. So let's not worry about what we can't control, but let's worry about the things we can. And the whole thing about this is it's one word, just being deliberate about your personal finances and your retirement plan. Just be very deliberate about it. Take control of it. So keep calm and carry on. So we talk about crises. So one of the things that roils the markets historically are these so-called international crises. What was yesterday? I don't remember that, right? That was an international crisis. I have a relative that put 100% of their money in the stock market right after 9/11, and I was thinking, they shut the markets down for 5 days. International crisis. But it didn't last long. So the interesting thing about these international crises, 51 of them since 1900, big ones, is very quickly the market will go down on average about 7%. Then very quickly it's back up 9%. So that's the history on that, and that's the reason why you want to maybe turn off the news or not get too consumed with an international crisis that historically they blow over and life gets back to the way it was before the crisis pretty quickly. Goes without saying that we want to keep saving and investing. So October 2007, market was falling apart, starting to fall apart a little bit. Really fell apart 2008, 2009. But I was still investing $100 a month into a retirement plan. And from 2007 until 2014, 7 years, I invested $7,700. What do I have to show for that? It all went into the market. So now, magically, it turned into $12,238 because the market went up over that time period. But had I been totally freaked out about the recession, what was going on, altered my plan, and I said, I'm going to go into bonds, I'm going to go into cash. Instead of $12,238, look what I have, $8,414. Money market, I had $7,727. So there's a lot of people that regret not staying the course through that bad economic time. I don't know about you, but I hate regrets. So stay the course there, and it's kind of magical, how quickly this thing can turn around, or interesting the big differences. So we talk about our comfort level with risk, and I believe we're getting ready to hand it off to Melissa here. You can go through and just kind of think about your situation. Art said, we're not necessarily saying to be 100% in stocks, but you can come up with a mix of stocks and say bonds, stocks and safe funds, to where you're confident you can stay the course with that particular mix. One such mix for a lot of people is called a balanced fund. So a balanced fund, 60% stock, 40% bonds. So in that scenario, over the long run, it's returned about 7%, pretty good, but it has a lot less volatility. So if you're the person where you really think volatility is the enemy, we don't think it is. Volatility is really not look back, it's not the enemy. It's actually been your friend because it creates buying opportunities. But if you don't want to endure, you want to endure less volatility or sleep better at night because yours is not fluctuating as much, think about a balanced fund. And think about your situation. If this goes down X amount of dollars, I can hang in there with it. So you put that together, and you won't have the problem of changing lanes when you should be staying in the correct lane. And with that, I'm going to turn it over to our prize.
Please don't set those expectations.
Okay, so she's going to bring it home, and I enjoyed talking to you here this morning.
So I'm going to start. First of all, I think if you polled my husband, he would say the same thing about shopping with me, like he wish he could stop me from shopping so much. I'm telling you that because I'm human and I make mistakes just like everybody else does. I think, how many bow ties and suspenders does my toddler really need? But they're just so cute, I mean, he never wears them. He wears T-shirts and shorts to school every day. So anyway, I'm right there with everybody else, making these mistakes over time. But I want to talk a little bit about diversification. Art has touched on this just a bit in the beginning, how to diversify to make sure that we manage risk, because the risk that most people tend to think about, is when it comes to investing, we usually only think about stock market risk. That's like the only risk we focus on, that we could potentially lose money if we invest in the stock market. But there's other things, there's other types of risk when it comes to investing, especially for the long term. And we have to keep that in mind as we're coming up with, how to diversify our portfolio. And being 100% in a fixed fund, you don't realize that you're taking on another kind of risk, which is the risk of your money actually losing value long term. So if we fast forward in the future 20, 30 years, is stuff going to cost more than it does today? Most likely it is, right? If we look back 50 years, stuff costs less overall. So we know that that's something going into retirement, stuff is going to cost more. The price of stuff's not only going to go up while we're working and saving, but does that keep happening even after we retire as well? They don't just cut us a break and say, you can pay the same price for milk for the 30 years in your retirement and everyone else has to pay the higher price. So we have to protect against that as well. And, the fixed account, it's great. It's a kind of a guaranteed interest rate that we get, but it does take away your purchasing power long term, and especially into retirement. A lot of folks think that just because you're close to retirement or about to retire, that means you're supposed to become very conservative and move everything into a fixed account. But we've got another long-term time frame to think about. So right now, we're all working hard and excited about retirement. So we're thinking about that long-term time frame up to retirement. But there's also the time frame of retirement until the day we die, which is hopefully another long-term time frame, something we can't really control. But as Mark, my good friend Mark over here likes to say, we as humans have a 100% mortality rate. So it's not really if it's going to happen, it will happen. But hopefully we have a long retirement to think about as well. And, there's all that time frame where we've got to also keep pace with inflation through retirement. So we've talked, I'm not going to beat 2008 to death here because we've talked about that so much. But, that is probably the most recent significant downturn in the market that we've had. We haven't really had anything that big since. But, if we look back to that time frame, Art touched on this as well, people tend to have a very emotional reaction to the stock market. And if it goes down, we need to get out of it. And when it goes back up, we come back into it. But honestly, if we can come up with a diversified portfolio, that's what we want to do. And we want to stick with that, whether the market is up or down, to make sure that we're protecting ourselves against multiple types of risk. So Everyone's probably heard the saying, buy low, sell high. We've talked about that as well. It's really hard to do that if we're trying to intentionally do that because we can't predict that, right? We can't say, I know the market's going to drop tomorrow. I saw Trump tweeting something, so I know tomorrow it's going to drop, and so I should put more money in. But with diversification and automatic rebalancing and things like that, you automatically buy low, sell high. So you're taking advantage of that. Without trying to figure out what's going to happen tomorrow or next week or next month. So with that being said, is there a risk of being too conservative with your retirement accounts? Hopefully we've kind of hammered that home at this point. I think I'm like the third person to talk about that now because there's 3 of us up here. So I bring the main point of this slide really is to look at no matter what the market is doing, we want to look at what our retirement goals are and figure out how we should be allocated based on our retirement goals, not based on what the market is doing today, yesterday, tomorrow, 2 years from now, 5 years ago, et cetera. So the other way we can diversify, not just with our investment accounts, but also with other types of goals or savings that we need to set aside. 457 plan is not your emergency savings account, okay? You have the ability to take money out of it in an emergency situation, but honestly, if you have an emergency, let's say my air conditioning goes out, which would be horrible right now because it's been 100 degrees here at least the past couple of days. But if my air conditioning goes out, where should I go to get money to fix that or replace that? Yeah, my credit card? No. Wrong answer. Incorrect. Take her lunch back. No, I'm just kidding. No. Well, someone else said savings, I think. Ideally savings. You want to have enough money in your savings to be able to pay for things that may come up on the short term so that you're not tapping into credit cards or your retirement account or other things that are meant for other goals. So it is important to make sure that we do have some money in kind of the short-term emergency savings as well as our retirement savings. Does anyone know what the recommended, how much money you should have in a savings account at the bank? How many worth of expenses, right? Maybe some of you have met with me before and I've told you that. Yeah, 3 to 6 months worth of expenses. So, if you're on the more conservative end, maybe 6 months worth, but at least 3 months worth. So if something happens, if you or a spouse is out of work for whatever reason, you have somewhere to go where you don't have to tap into that long-term savings, which is what retirement savings are. Who's heard of compounded interest? Anyone want to take a guess as to what is the definition of that? Mortgage? No. Thank you. Interest on your interest. Yeah. So as you earn in your account, now those earnings are also earning for you. And that will grow exponentially the more time you have. So time is your best friend when it comes to long-term savings because of that compounded interest or compounded earnings. But what happens if I go and take an emergency withdrawal or a loan and take a lump sum out of my retirement account? I'm really hurting the ability to have that compounded earnings build up. So that's why it is, again, important. I'm making the case for the savings account here, but the retirement money, we want it to go in there. We want it to leave it alone so that it can do what it's supposed to do long-term for us for later down the road. I think Mark said, or had a chart that said time in the market is more important than timing the market, which means long-term, we want to have our money in the market, come up with a strategy that works, leave it alone, let it do what it's supposed to do long-term for us. And that continues even after retirement. That takes us up to retirement, but that also takes us through retirement as well. Isn't that puppy cute? I should have brought a puppy with me to this presentation. So occasionally people will ask me, what do I think about investing in gold? Or back in the day when Facebook IPO'd, I'd really like to get some Facebook stock. That's not for your retirement account. Okay, so anything that you kind of want to mess around with or play with, that should be a separate account that you set up. So that's okay. So my little fun account, I have a little E-Trade account that I use, and I'll put a couple $100 in here and there, and I'll buy stocks with it. I'm not a big stock person. I know this is my, finance and retirement planning. This is my thing. I'm more into my long-term savings, my retirement plan, my mutual funds. But I do have a couple stocks, and that's my kind of play money, though. I don't call it mad money. I don't consider myself mad, but, it's fun. And, you know, if it goes up, it goes up. If it goes down, I'm not losing my shirt over it. So if you do want to kind of play around with stuff, especially individual stocks or any other sort of speculative investment, just keep that separate from your retirement money. You know, we want that invested, but we want it to grow at a rate that's reasonable for retirement planning, and not, you know, be all over the place when it comes to needing it for income purposes. Does anyone remember what happened to Facebook stock? What happened to the price right after it IPO'd? It tanked, yeah. So, and it's fine now, but if we go back to our human emotion, you know, if I put a couple $1,000s and bought some Facebook stock and then it tanked, you know, how would I react to that? I wouldn't be happy, right? So again, that's fun money. If you can't stomach that, just don't do that, okay? Just stay away altogether. We can talk about mutual funds instead. So, you know, that's, like I said, that's my little E-Trade account. It's separate from my 401k. It's separate from my retirement stuff, but it's a little fun account that here and there I'll buy a stock. I'll ask some of my coworkers, just tell me what stocks, you know, because I don't have the time. I'm not that nerdy, but we do have a few folks like that. So we have a great tool on our website. If you've met with me, we've walked through this. Maybe you've done this on your own, on account access or on our app, but we've got a tool. It's called Am I on Track? So you may have logged in and it says, congratulations, you're on track. Or you may have logged in, it says in big red letters, unfortunately, you are not on track for your retirement goals. Which is good because guess what? It gets you guys coming to meet with me. You're like, why does this thing say I'm not on track? But what that tool does is it kind of helps you with all of these steps that we have listed here, is help you, first of all, get set up with where you want to be when you retire. If you're not sure when you want to retire or what kind of retirement you want to have, you know, we can mess around all day with the investments and the mutual funds in your account, but we really need to have an end goal in mind. I like to practice retirement. So I did that last week. I was at the beach. Luckily, I was on the side of Florida that did not get hit with a hurricane. But the week went by like that. And I said, you know, like all vacations, it was way too short. But I said, that's okay. I'm just practicing retirement. You know, one day I'll get to go to the beach and I won't have to worry about going back home and going back to work. I can just stay at the beach if I want to. But knowing kind of what you want to do when you retire, where you want to be, where you want to spend your time, what you want to do with your time, et cetera, that's going to help us put a plan together better. And then, again, focus on the things you can control. Can you save more money? Could you, if you needed to, could you work another year or two? I know that's everybody's favorite option, but it's better to know that stuff younger than waiting till the last minute and realizing maybe I don't have enough set aside. You know, let's look at that stuff now. We've probably mentioned rebalancing as well. Does anyone know what is a rebalance? If I rebalance my portfolio, what am I doing? Yes, we're on the right track there. So if I set up a portfolio of 50% stock and 50% bond, just to keep it simple, and 10, 15, 20 years go by, the stock part is going to outperform the fixed part of my portfolio, which means now that the stock part is going to account for a bigger percentage of that pie, right? It's no longer 50-50. So that means that now my portfolio actually is quite a bit more aggressive than it was when I set it up. And I might not realize that. I'm looking at it thinking, hey, it's growing, it's great, I left it alone. Rebalancing basically sets you back to that initial allocation. So it's like, I've set up this portfolio, this is the way I want it. Rebalancing on a regular basis sets it back to that intended allocation. And that means kind of what you touched on a little bit was just your buy low, sell high every time you do a rebalance. You sell off the overperformers, buy back into the underperformers. And that's done on a recurring basis, not a trying to time it basis or figure out what's going to happen next with the market. So automatic rebalancing, whether it's quarterly, once a year, you know, we have programs that help you do that. But if you're doing that quarterly, twice a year, once a year, you know, it's important to make sure you're maintaining the same kind of level of risk that you wanted initially. And don't freak out and sell all your stuff in the market. I think we've already touched on that, but small changes, okay? Maybe you're not comfortable with the market. You want to move a little bit of money into fixed. That's okay, but it doesn't mean that we need to make drastic changes. That's where we hurt ourselves. We've seen in all the charts that we've been shown that long term, we can get a pretty good rate of return out of the market, but we have to be consistent. We have to stick with it, or as Mark said, be deliberate with it. So come talk to me if you're having a panic moment, okay? I can also be a counselor. I'm a good listener. So if you want to talk about it before making changes, I would highly recommend that. I can talk you off the ledge. I have to talk myself off the ledge sometimes, so, you know, I'm used to it. So I wanted to take a minute just to talk about our Guided Pathways program. This is a program that's available. Think of it as just another level of service that's available in your ICMARC account. Some of you are already enrolled in this program. It's a program that helps you answer a lot of the questions that you may have based on all this information that we've just talked about. Diversification, rebalancing, you know, am I in the right place? Do I need to make changes to my investments? Are my retirement goals realistic? Am I saving enough money? So this program has 3 levels of service, going from the kind of most basic level up to the most hands-on for ICMARC level. And it really just depends on how hands-on or hands-off you want to be with your investments. I meet with a lot of folks who set something up, and then 20 years go by, they keep saving, and you know, they're like, I haven't really looked at it. I look at it, but haven't really done anything or made changes to it. And you've probably done okay if that's been your strategy, just because you weren't selling when the market was down. But to make sure that you're in the right mix of funds based on when your retirement is going to be and how much income you're going to need coming in, these programs can help with that. I'm not going to go into super detail here on each level, but again, it's basically how hands-on or hands-off you want to be with your investments. The reason that this service is there is because a lot of folks come to sit down with me and say, how am I doing? Am I in the right funds? Am I going to be okay for retirement? And this program answers those questions for you. So it's easy to use. It's like I said, just think of it's another level of service that's available for those who would find value in it. But it's a little more tailored to each individual. I mean, every single one of us in the room could say we're retiring in 20 years, right? We could all just say 20 years, that's it, we're all retiring. But are we all saving the same amount into our 457? Some of us might have pensions, some of us don't. We're all different ages, probably, I'm assuming. I don't know, I'm looking at us. But so individually, things could differ for each of us, even though we all say we're retiring in 20 years. So where this program is beneficial is figuring out what you should be doing. Like I said, if we're all retiring 20 years from now, we all have different stuff going on. So that means that the advice, the guidance could be different for each of us, even if we are retiring in the same year. Okay, this is pretty sad. In this room, it's 100% though, right? Everybody in here has calculated how much they're going to need for retirement, yeah? Well, we're going to after today, though. And that's why I'm here, to help you with this. We can do this. We can run these numbers with our Am I on Track tool. We want to know what age you want to retire at. We use your salary to figure out what income you're going to need in retirement. So a lot of people don't know that. It's how much am I going to need coming in? We use your salary to figure that out. So salary plus some kind of cost of living along the way, whatever that works out to at retirement age, that now is the income that we need to replace. And we need to replace that every year in retirement until the day we die. Does anyone know what age they're going to die at? Some people come to me and they'll be like, 76. Everyone in my family died at 76. But usually it's the public safety folks. You guys know what I'm talking about. Yeah. Hey, I appreciate the realism, though, Some of us are scared to talk about death, and we shouldn't be. We need to make sure we're set up for when that time will come. But we use very conservative ages for life expectancy. We actually use 95 for women and 92 for men. And you're still going to be healthy and traveling and running around when you're in your 90s. But we do that for a reason. We want to make sure that your money lasts longer than you do, essentially, not the other way around. So that's when we're looking at income replacement, we're looking at a lot of years, right? If we're retiring at 56, 57, 60, 62, that's a lot of time to be replacing income. And what's that one thing that's going to affect our income or our purchasing power in retirement? What's that one thing we talked about, that I word? Yes, inflation, thank you. So the cost of stuff keeps going up, which means you almost have to give yourself a raise in retirement every year as well. So making sure your investments are growing at an appropriate rate makes sense for retirement once you're already retired as well. But this is gonna be 100% once we're done today. Everyone's gonna schedule an appointment to go through this, go through those numbers. So the Guided Pathways program, once we've kind of figured out where you're at, we can tell you how much you should be saving towards retirement. We can tell you if your retirement age is realistic. Like I said, it's better to know that now than I'm retiring in 3 months. I don't care what you say. You know, I'll see you back at work in a few years, I guess. So is your retirement age realistic? And then based on the income sources that you have coming in, is that going to be enough to replace income? Some of you have pensions, some of you it's 457, 401, maybe Roth IRA, Social Security at some point in the future, any other sources of income that you have, and to see, you know, how on track you are to replace that income throughout the rest of your life. We also help you with how to take withdrawals. That's, you know, something you get up to retirement and it's exciting and ready to go, but there's so many things to think about, you know, on the other side that we've thought about, but you know, it's kind of a new world. Once you get there, we're not sure, now what do we do? Now what do you do with our money? How do we take our money out? What's the best way for me to withdraw to my accounts? And our Guided Pathways program helps you with that as well. So once you get to retirement, we can help you with that. So let's talk about what that costs, because that sounds like a great service, doesn't it? Oops, let me go back. Okay, so I talked about Guided Pathways in general, and there are 3 levels to that service. The most kind of hands-on level, which is, I think some folks in the room are enrolled in our managed accounts where we manage your investments for you. Just because your coworker says, this is a great fund, you should be invested in this fund, it's what I'm invested in. I mean, that doesn't necessarily mean that you should also be invested in that fund. We're all different. We got different stuff going on. So to get a kind of analysis of where you're at and see if that is indeed the type of investments you should be in, this is important. You know, what's good for someone else is not necessarily good for me or what I should be doing. But the managed accounts, if you decide to have your accounts professionally managed by us, and we do this by running those numbers that I talked about, what age you want to retire, income needs in retirement, what other sources of income you're going to have coming in, and amount that your savings rate. We charge less than 0.5% on what's in your account, up to the first $100,000, and then it goes down from there. So it's a very reasonable cost for the service or the value that you get out of it. Has anyone met with a financial advisor before and talked about how much it costs for them to have you manage your account? It's usually more than double this. And they're using the same services and programs that we have. You're in this public sector safety umbrella, as I like to call it. ICM ARC is a private nonprofit firm. We're providing a service to you basically at cost, if you want to think of it that way. We're not trying to make commission or make money off of you. So it's a really good deal. If somebody wanted to get an idea of what that would cost on your account, we can run that for you. But this is just an estimate here. That 0.4% is an annual amount, so it's basically on $1,000, $4 for the year that way. But here's an example just to show you within a hypothetical balance, 110,000. So again, it's a service that's available. If you're not sure how you should be invested, if you want to make sure you're in the right funds, we rebalance your account for you every quarter. We will also make strategy changes to your investments along the way. So your strategy now could be different than 20 years from now, what your strategy should be, and it probably will be. So we automatically adjust that for you along the way to make sure you're always in the right funds, whether you're working, almost retired, and even later in life. If that sounds like it would be valuable to you, I would consider it, and I can talk to anybody one-on-one about that as well if you're interested in knowing a little bit more. What questions do you have? I've talked a lot, so questions on anything that I've covered? I feel like I've been blabbing up here. Everything was just perfectly explained that we don't, okay. So typically, so call HR. We are usually at least twice a month in HR. But we do try to periodically, once a year or so, come to other departments if we need to, come on site, sheriff, in other places where it's harder to get away. So at least twice a month. But HR can say, retirement lady will be here next Wednesday. Can you be here at 11? So Any other questions? These people were just like, that was just so amazing. I have to go look at, am I on track? I have to log into my account online. Yes. Yes. So if that's what you've opted to do, you're supposed to stay in it after retirement, because we will manage you as a retiree then at that point, and as someone who's not accumulating anymore but withdrawing. So yeah, absolutely. So it's not, yes. So if you've put in your papers and I'm retired, we're gonna know that you've separated service and retired, because we also put a retirement age in there as part of the forecast. So that's all gonna happen automatically. Any strategy changes will happen automatically without you putting your hands in the pot at all. So it's not just tied to your retirement day or age. There's a lot of factors that go into how the portfolio is managed. So, just because we're closer to retirement or already retired doesn't mean it automatically says, now we got to be conservative. We are going to make sure you're in the right funds now that you're retired or close to retirement, based on creating income from those buckets long term. So it could be adjusted. It can be adjusted throughout that period. So up to, close to, at, and then even beyond retirement. Yeah, so if the program is meant to take that decision making away from you, as well as prevent you from being too emotional, I would actually argue that the best value in managed accounts comes when there's a market downturn, because that's when people tend to make that emotional decision and say, I shouldn't have X amount in the market anymore, I need to make a change. And we've seen already from all the slides we've looked at that hurts you. So if you say, hey, I'm not comfortable, or I don't want this portfolio, you would opt out of that. And then essentially you're managing it on your own at that point. You still have access to us. I'm not saying we're like, hey, have fun, see you later. But it's kind of an all or nothing. You're trusting us to make logical investment decisions for you based on your retirement goals. Or you say, you know what, I want to do this on my own. I'm going to opt out and do this on my own. Hold on, let me find $1 million in my pocket. No. So you're talking about like having some money in, some money out in management? No, it doesn't work like that. So you're either, because it doesn't make sense for us to manage part of your portfolio. We're managing the whole thing, or we're not managing it for you. Actually, it sounds like a great relationship that you're benefiting from. I look pretty trustworthy, don't I? Thank you. You mean for like that am I on track when you're... So it's going to be based off of what you're invested in at the time. So, just if you're in a super aggressive portfolio, it's going to assume a more aggressive rate of return. If you're in the fixed account, it's going to assume a pretty low rate of return. So it depends on actually what you're invested in. So it's pretty realistic. I don't think I would say that. I would say if you're, based on your asset allocation, so if I'm 100% in fixed, it's going to assume a fixed rate of return. If I'm 60% in the market, 40% in fixed, it's going to assume an estimated rate of return for that type of portfolio. It's not going to look just, every single investment, this one did 15%, this one did 2%. It's not quite that specific. It's basically an estimated rate of return on how your assets are broken out, what asset class you're in, or classes that you're in. We can talk more one-on-one if you want about that, or anyone else who has questions like that one-on-one. Any of us are happy to talk to you one-on-one as well. Yes? Oh, I mean, you could, but there are some restrictions on doing that, only because there's always people who try to mess up the system, right? There's always somebody, not you, but somebody's already tried this. So for the managed account, we charge the fee, I think it's at the end of the month, based on what your balance is. And what people were doing is they were going into managed accounts to get the management and then opting out at the very end of the month and then opting back in at the beginning of the month, so they weren't getting charged. So, like I said, there's always someone ruining the system for us. So you could technically do that, but we're going to get a little red flag if you're like, every month I'm going back and forth between the two. But you could. You're just taking away that active management part. It's like fund advice is one snapshot in time, this is where you should be, but it's not any of the ongoing part of it or adjusting along the way. You could, so, I mean, I would just say don't go into managed accounts if that's what you would say. Because the managed accounts is for someone I don't want my hands in the investing. Please handle it for me professionally, logically, you guys do it. It's a long-term, it's meant to be long-term. Technically, yes, you could do that. That's the short answer. It's turned into a longer one. No. It's cumulative. Yeah. And honestly, if you want one of your accounts managed, there's no reason to just not have it all managed, because we're trying to get you to one overall asset allocation. So we're looking at all the investments that you have. And if this is invested this way, then we have to compensate on how that's invested to make your overall allocation a certain way. So it's cumulative. The cost is for your total, Roth, 457, 401, all of it together. Did you do that with me? I don't remember. Let's talk one-on-one about that to make sure, yeah. Elizabeth's. She's got the hook ready to drag me off stage. No. I have business cards as well, and I should have said that before half the group left, but oh well, they don't get my business card. So, thank you for coming. Yes, let me get those. Okay, good.